Hey, what's going on everyone? My name is Aaron. In today's video, we're going to be talking about just how possible it is for the average retail investor to achieve dramatic stock market gains and the power they have over institutions. If you enjoyed the content, please leave a like on the video, subscribe to the channel, and let's get right into it. Okay, so a little bit of background. Warren Buffett, one of the greatest investors in history, once said that if he was managing a portfolio of around $1 million, he could guarantee returns of 50% per year on average. So this all boils down to outperforming the general market. So ever since the S&P 500 and other stock market indices have been established as the benchmark for the market's annual return, there have been people, primarily institutional money managers and investors, that have claimed that they can consistently beat the market's average. And this is the first crucial point to understand. It's the whole reason why people use investment managers and money managers and invest in these actively managed funds. It's the idea that these individuals are able to beat the market's returns. And after all, this makes sense. If institutional money managers couldn't consistently beat the market, then individuals would be better off just buying and holding simple index funds and saving on those fees. However, if you look at the historical returns of actively managed funds, the results are actually pretty dismal. In fact, Barron's did an in-depth study where they found that over the past decade, only 22% of actively managed funds were able to consistently beat the overall market. And remember, this study only looked at funds that had been around for over a decade, meaning that some funds who had only been around for maybe a couple years and ended up closing down because their returns were so poor, they weren't even included in this study. So the actual figure of funds that were able to consistently beat the market is lower than 22%. But regardless, this study shows that despite the conception that actively managed funds should be able to consistently beat the market, in reality, they're just not able to do so. Okay, so on one hand, we have these institutional investors that are just unable to beat the market consistently on average. But then we have Warren Buffett on the other hand, who's claiming that if he was managing a small portfolio, he could bank 50% returns per year on average. So this then begs the question, people like you and me, the average retail investor who have smaller investment portfolios, what's so special about us that we could potentially have an edge over these institutions? And it all comes down to this, OPM, or other people's money. So other people's money is the lifeblood of the entire financial services sector. So think about it. If you're an active fund manager, your whole goal is to acquire clients. Those clients then give you their money, which you then go and use to invest. That's how you get that element of other people's money. So then the manager then makes their money by charging their client fees based off of how much money they have invested. And I'll say that again because it's very important. The manager makes their money based off of charging their clients fees. So then let's think about this logically. If you're an active money manager, if you're an investment firm, if you're an institution, and your entire living is based off of managing other people's money, what do you think is rule number one of these institutions? Don't lose your clients' money, because if you lose your clients' money, you're going to lose your clients. Okay, so we know managers can't afford to lose their clients' money, but we also know that the stock market is an inherently risky place, even for the most experienced or intelligent individual. So how can these institutions, how can these active money managers in these funds essentially de-risk an inherently risky endeavor of investing? So essentially these funds implement certain strategies to help de-risk themselves. So for example, they'll have extreme diversification, and the benefit of diversification is that if one of your bets, one of your stocks go south and it ends up tanking, well, your whole portfolio is fine because you have a bunch of bets placed elsewhere. On the flip side, if you had all your clients' money invested in one specific stock and that stock went south, then you would lose your client money and you'd be in a pretty bad situation. And then another common strategy funds implement is that near the end of every quarter or near the end of every year, these funds will actually sell a lot of their winning positions. Now, why do these funds do this? Well, it's simply just to lock in gains, which they can then show to their clients. Remember, towards the end of every quarter or towards the end of every year, that's when you're sending statements to your clients showing how much money you made or how much money you lost. So as a money manager, your best interest is to maintain your clients. Therefore, no matter what the market's really doing, even if you have more upside, you still want to sell those potential winners to then show off to your clients. So remember, I'm not saying that any of these strategies are necessarily bad. At the end of the day, when you're managing other people's money, your goal is to mitigate risk. But what I am saying is that the individual retail investor doesn't have to worry about these factors. And this is really the key behind Warren Buffett's claim of 50% returns per year on average. It's the idea that the smaller individual managing a smaller portfolio doesn't have the burden of having to constantly provide returns to their clients. And on top of that, they're not burdened by the fact that they're potentially managing billions of dollars. So again, unlike institutions, we, the average retail investor, we can afford to sit on a flat or even a declining portfolio for months or even years on end because again, we don't have to worry about constantly providing those marginal gains to our clients. And this allows for the key of flexibility with the retail investor. You don't have clients calling you on the phone asking you, are we invested in this? Are we invested in this? I'm worried about this. You don't have any of that. So you can invest with more flexibility and you can invest with a more long-term mindset. Again, Tesla is a great example. Tesla traded sideways for many, many years. Now, if you're a retail investor, you can afford to sit on that portfolio with that stock going sideways for a long time because there's no pressure for you to make those massive gains immediately. Versus if you're an institution and you have clients and you're investing other people's money, well, they don't want to have their money sitting flat or even declining for years and years on end. They're going to take their business elsewhere. And you as a money manager can't afford that because then you're going to lose clients and you're going to lose money. And this example is precisely the benefit that the retail investor has over institutions. The institution has to be worried about not losing their clients because if you lose your clients, then you lose your income. So they're forced to invest with this short-term mindset where they have to provide, quarterly returns and yearly returns year after year, versus the average retail investor like you and I that can afford to see the big picture and afford to buy those high conviction stocks and be willing to hold them for the long term. And that's where the true potential gains lie, and that's the real advantage that we have over institutions. I want to thank you for sticking to the end of the video. Please go ahead and leave a like, subscribe to the channel. Let me know, do you like my haircut? I got a haircut recently, but leave a like on the video if you enjoy my haircut. If you don't enjoy my haircut, please also leave a like on the video. It helps out tremendously. And yeah, I'll see you.